Good morning, good afternoon, good Saturday, everybody out there today. Another wild week in the markets, particularly in the US stock markets. We're seeing things sort of swinging all over the place. I don't think everyone necessarily understands what's going on or why they're going on. There's also some political factors that play into this as well, although we won't go too much into that. But I just want to touch on a few things today, understanding why we're seeing rising bond yields, why that correlates into stock market price drops, especially in the tech sector. We also see that U.S. and China relations are definitely strained as usual, but right now we're negotiating over on this topic, and that's producing a bit more market risk on top of everything else. And there's understanding sort of the correlation between those things. Before I jump in, as always, please hit the like button and subscribe if you're not already. We really appreciate it and want to definitely try to grow the channel as much as possible. Additionally, I am not your financial advisor. I am not a CPA. I am not an attorney. I'm merely offering my own thoughts and opinions on these topics, and this is for education only. So please always seek out professional, certified, licensed guidance, anything when it comes to finance and otherwise. So let's jump in. It's been a wild week in the markets, right? We're seeing yield prices starting to rise across treasuries. So as of the timing of this, 10 years were at 173 and 30 years were just under 2.5 at 2.437. I want to just address something really quickly because I've been seeing a lot of questions and a lot of comments around this of people saying, why would you put your money into such a low interest rate? They didn't understand. It doesn't make sense because, at 1.73 for a 10-year, you're not even beating inflation. So I think that this is a common misconception from the retail trading and investing world, is that we tend to look at things from the purview of an individual investor and, hey, if I can get a dividend of 5% over here, why would I possibly want to pick up a 2.5% yield? The first thing you have to understand is when we're thinking about yields, to even be in that market, you're typically talking about very large institutional level trading. Think, tens, hundreds, billions of dollars of buying happens. Also, when we think institutional traders, this could be gigantic funds, hedge funds, private equity funds. This could be the Fidelities, the State Streets of the world. This could be the JP Morgans and the Goldman Sachs of the world. This can be sovereign wealth funds. This could be entire countries, which is actually kind of a great segue here. China is one of the biggest buyers of U.S. treasuries. So it's important to understand that when we're thinking about why people are buying treasuries in this 1 to 2 to 3% range, it isn't meant to be a play necessarily on, hey, it's not going to grow as much as a growth stock. I don't think anyone's really debating that. I think you have to understand that yield prices are very correlative to risk and the way that certain types of businesses and investment firms have to go to market. So if you're in the fixed income world and you're trying to provide predictable long-term income for your investors, rising rates are great. Yeah, they may not beat inflation, but they're very safe. They're very secure. They're AAA rated typically in the US. So you have to think about it not in terms of, why would I, an individual investor, go and put my money into this? Most likely, you're probably not going to, and for good reason. I will tell you just personally and transparently, in the past, I have invested in 30-year treasuries myself. I plan to hold those for 30 years. It's a nice stream of income every year. And then at the end, I get all of that original investment back. I do tend to reinvest them and try to double down on that. It's a very, very small piece of my overall portfolio. But I treat it the same way the institutional traders treat it, as it's a very low risk, very consistent source of income that sort of is always going to be there and be very steady. I like to think of it in terms of the ability to sort of go against my mortgage as well. Is there's something guaranteed there? As I'm paying off for 30, I'm getting something in for 30. Now, the reason this is important is I think there's an underlying understanding of bonds that are very confusing to folks. And you really have to understand there's a lot of correlation, a lot of balance between the two. The reason why bond yields rise is because the underlying value of the bond is either going up or going down. So assuming a bond was to come out at $100 per bond with an interest rate, say, of 2%. Well, as stocks become more enticing, better yields, the risk to reward ratio is reasonable. We think we can get in. What you'll see is people start to pull their money away from secure things like bonds and go heavy into the markets. This causes bond prices to lower while the stock prices go higher. Makes sense, right? We're all leaving this one area. The prices are going to be pushed down a little bit over time. We're all jumping into stocks, which is driving the prices up. Stocks will hit a point, whether it's due to just simply being overpriced or perhaps macroeconomic factors like, the U.S.-China talks that are going on right now. It could be that there's wars happening in parts of the world. It could be a number of different things, politically speaking. It could just be general risk of the markets. It could be uncertainty of the future. What will start to happen is over time, those folks who are sort of starting to feel the risk. And again, I really want to focus especially on the large scale institutional investors, hedge funds, the big players with billions of dollars to work with. What will happen is they'll see that rise. They've already made some of that money. They're going to then start to take the money out of that market and now go after the bonds. Now, the reason those prices in bonds the yields have gone up in bonds is as that original $100 bond maybe drops down to call it $90 for the sake of kind of easy math. We see the 10% drop there. Now that original 2% yield that you might have gotten on that is now still 2%, but you're only paying $90 to get it. So that's creating an uplift in the underlying yield price. So as those yields rise, that's what happens. We start to see equilibrium where now money starts flowing out of the market. It flows back into bonds. The bond prices start to rise. Those yields start to come down a little bit. There is a point of equilibrium where maybe it makes sense to be in one versus the other. It depends where you are from an investment perspective. It also depends on what your investment goals are. There are a lot of firms whose only business is fixed income investing. From a personal retail trader perspective, or what I would say like a household investor, I think it's also important to understand that when you're thinking about where you are in your investment journey, will also correlate to how you invest in these things as well. When you're on the younger side, there tends to be more of an appetite for risk. Your overall portfolio will oftentimes lean more towards 70, 80, maybe 90% even of stock and 10, 20, 30% in bonds. As you get older and closer to retirement age, typically you're going to see that start to move a little bit more, where you want to have more of that long-term security. You want that money to be safe but still producing income. And I think that's something you really have to think about here, is that at some points in your life, it's about growing as aggressively as possible. And at other points, you've already done the growth. Now it's time to make sure you have predictable, stable income that you can retire on. So the way an institutional investor or a country or a sovereign wealth fund handles this is very different than the way you and I might handle it, because our individual financial situations can be very different. We might be chasing things in a different way. We may not understand necessarily how these things work. So we go with what we hear out in the markets. And that's sort of the theme that I'd like to talk about here is I think there's a lot of great channels out there who talk about sort of the really baseline stuff, how to make an investment, what a dividend is, how to put money into a stock. And I think that's really needed and really important. I think once you get past that initial layer of what investing is, it's really, really particularly valuable to be able to start peeling some of the layers off and understand what's driving the market. How does macroeconomic factors drill in? Where do macroeconomic factors push and pull in the market as well? And this is sort of a good segue. Once we understand why, rising yields means stock prices tend to go down, it's actually kind of interesting, because the other thing I was going to talk about was really this US-China conversations that are going on. I had posted something the other day that this presents yet another and newer risk to the marketplace. And the reason is any sort of feeling of instability, whether it's very minor or very major, will have some degree of impact. I oftentimes like to think in terms of statistical relevance. And what I mean by that is there are going to be some events that maybe move the markets very slightly. There could be some that are very significant and have a very large and relevant impact on pricing. With China and the US currently having relations and not going very well, right? Not bad, not terrible, but not seeing eye to eye. This means that there are a lot of things that are just going to be sort of slowed down on the back end. As one of our largest partners, the US, China and US, on an economic perspective, we have to be pretty tight on what our expectations are, what our agreements are, how we're going to flow through the years, how money's transferred, how products are imported and export, how we have investments between the two countries. So any sign of that not being aligned is enough to make, again, we're focusing on these large investors. It's going to make large institutional investors a little bit nervous, which gives them more pause to pull money out of the market because it becomes unpredictable. And yet another reason to put it into fixed income products like 10-year bonds, for example, at a 1.73 rate, because that 1.73, sure, it's not a lot of money in theory, but when you're talking about billions, tens of billions of dollars, that is a significant amount of income while you're waiting to see what's going to happen. So you're still generating return and waiting for your next move and what you're going to put that money into. Now, in sort of ironic way of looking at this, as we're talking about bond yields and market risk, it's also an important note that China is one of the largest, if not the largest buyer of US treasuries. So even in the most recent treasury release, which this happens every month, the 30 years, the 10 years, and so on, you can get in on them every month. You can buy small amounts, like I said earlier, like I do, or you can be an institutional investor buying, tens of billions. Excuse me. I knew there's a sneeze coming. Excuse me. Good allergies in the Northeast today. So I think there's a lot of dichotomy between the way things move. There's a lot of delineation between why things happen and why they don't happen, and then correlations between what comes together and what that means from a pricing perspective. I always find it very ironic and sort of funny that we're constantly having battles with China, for example, while they're also the biggest buyers of our treasuries, and also that buying also affects our overall market prices, which affect all of us as retail traders and investors. One of the themes that I speak to really regularly on this channel is this idea of risk mitigation, risk understanding, and just being aware of how things can impact you. I think that when you're a newer trader or a new investor, there's sort of this natural sense of the first thing I want to do is pick some stocks that I know of that I'm really, really familiar with. Maybe it's Tesla or Ford or Bank of America or whatever the case might be. It's a company you've heard of and you feel like you know a little bit about. And you know a little bit about it. You think the business is going well, maybe make some investments or trading there. There tends to be sort of that second level of like, I'm going to learn about technical analysis because technical analysis will help me make decisions based on what I'm seeing on the charts and how things have moved over time. And it doesn't take a lot to learn, simple moving averages or exponential moving averages or Bollinger Bands. It's easy to read a couple of articles on it, get a feel for how to read and understand it, which is great, by the way. I think these are great progressions. I think where you really get into some interesting things is when you start to look at your investing from the viewpoint of really fundamentals and really market-based and macroeconomic events. Events can move stocks, it can move prices, it can move bonds in huge, significant ways that at times can be very unpredictable if you're not following these kinds of events. So rather than belabor the point, and I'm happy to go into details on this for anyone who's ever interested, but I think there's a certain amount of just learning the right things that I like to get out there. And a lot of this has to do with these large scale events, these political events. And I'm not talking about politics from a standpoint of voting for one party or another, or disagreeing with a stance on a particular thing. I'm talking about just understanding correlation and historical correlation between major events happening, disagreements with other countries, risk in the macroeconomic perspective, looking at how oil is being produced and how it comes back to the markets. When you're getting serious about being a trader or being an investor, I think it's particularly important to start to understand that all these different kinds of things out there all have an impact on the market. Maybe each one individually is only minor, but if there's 30, 40, 50, relatively significant events going on from a global perspective, they can really combine and create large market moves and a lot of risk. I think YouTube's almost like a great microcosm at times of being able to understand why and how this happens, because someone who hasn't been in the market, say like myself, since the late 90s, I've been through a lot of events. I've seen multiple crashes, lots of political changes. We've seen lots of macroeconomic blowups. We've seen, my gosh, I mean, there's been so many things that have happened. You can start to get a feel for it. I think that, the more popular YouTube gets and the more financial channels that come out, what I'm noticing is that there seems to be this preponderance of no real actual experience as an investor or trader, but a really popular channel that drives a lot of views and a lot of opinions, and they share a lot of how-tos. And I think that there's some risk in understanding that the past couple of years have been phenomenal in the markets. Yes, there have been down times, 100% there have been, but they've also largely recovered. So folks who are claiming that they're getting 20, 30, 40% returns, they could just be sitting in an index fund that happened to be bought at the right time. And I think this is where it's really important from a historical perspective to understand that you need to be able to go and back test your ideas and see how they would have played out in the worst of times, the best of times, what drove those events from happening. And that's why I try to talk about these things that are a little bit different than the standard, because everyone out there is talking about just invest in dividends, just go after tech, look at penny stocks. How can I sell complex and convoluted financial products to make some income? And the reality is, they may not know what they're doing, right? Like anyone can read a Wikipedia article and then go and regurgitate it with their own sort of like spin on it. I think it's just really important to understand that, you can't think in terms of me when you think in terms of global markets, right? It can't be about like why you believe something is happening. It has to be what is the correlation of the entire market as a whole and how it's impacted by events, by changes, by big technical gaps. I won't go and belabor your Saturday morning here or go too deep on this, but I just wanted to point out today that like a couple of things I've been hearing of this week, just to wrap this up, was there's definitely a major misunderstanding of why people are leaving stocks, especially high flyers in the tech space, for a 1.73% yield on a bond. And when I saw that, my initial reaction was like, oh man, I think folks don't actually understand it's not about the near term 1.73%. And then that got me into thinking about the fact that China was a big buyer, which then got me looking and thinking about the negotiations that are going on and how prices are moving and correlating and sort of reverberating around that. And if there's one thing you can take away from this, what I would really want it to be is, don't, please, if you're putting real money that you're working hard to earn and you're trying to build a life around your investments and your trading and your skill sets, it is extremely, extremely important to understand that you have to drill down. You have to peel back the onion to multiple layers to start to get a feel for why things are happening, right? One sort of exercise I do with some of my buddies and also my son is we think about a business and we try to drill it down and just keep pulling it layer by layer by layer. We sort of use Tesla as a funny example where we might want to look at the overall car market, how many people are buying electric cars, the popularity of a dominant brand like a Tesla. But then we want to break it down even further. What kind of production rates do we have? What could happen if those production rates slowed down or increased? What would happen if we couldn't get lithium for batteries? What happened if lithium miners had to go down because of COVID? What happened if COVID restrictions meant we couldn't even get miners into a mine? Like, this is the way to really think about how you peel back the onions of your investing. I'm not talking about scalping here over the course of 30 seconds because you see a price move. I'm talking about long-term, strategic, investment-focused money management and portfolio building. So with that, I actually maybe gave me the idea to do something on this topic and really drill down into some examples of what we're thinking through. Without further ado, hey, have a good Saturday and a Sunday. Hope the weekend goes well for you. And we'll be talking again soon. Thanks so much.